Hey everybody, welcome back. I hope you got to watch all of the first video. If you didn't, you really need to stop this video, go back to the first video, which should be right up here. Click on that link and go back and listen to that one, because we're going to talk about financing strategies for our example that we used in video 1. So we're going to cover hard money loans, cash financing, private lender financing, and then also refining with a conventional loan. So let's get started. Okay, so in that example before, and we'll just put all this up here so that we don't forget it. You had a $100,000 house that needs $15,000 in work, and you're going to try to pick it up for $65,000. And the reason you're doing that is because you have an investor that you know you could sell it to 84. So, or for you could sell it to them for 66. So we're just going to weigh out these financing options and try to learn. So hang with me. So first, if you were going to buy, fix, and sell this house, you could get a hard money loan. So what a hard money loan is hard money loans are asset-based loans. And you can find lenders all across the nation to loan you money on hard money. The problem with hard money is it typically equals to about 16% interest, plus or minus. So some lenders will give you the money for 10% and then 4 points origination, meaning that's the fee up front when they fund the loan. Or it may be 14% interest and 2% origination. So the first thing you have to do if you're looking at hard money loans is you have to get a good faith estimate and a term sheet and really understand the cost of the money, because that's going to change your return significantly. So the way hard money loans work is, in this deal, a hard money lender may have a maximum loan to value. It's a percentage, so it may be 70%. So the maximum loan that a hard money lender would give you in this example would be 70% of $100,000, or a $70,000 loan. Now, you're buying this house for $65,000, and it needs $15,000 in repair. What the hard money lender is going to do, he's going to make you escrow or leave this $15,000 with him or her. So what this means is you're really only looking at getting a loan of $55,000 at closing. So the way that works is if you're buying it for $65,000, you're actually going to have to bring $10,000 to closing, plus any prepaid interest, property taxes, insurance, closing costs, and the points. Remember the points, the origination. So the lender is going to charge you, we'll just say 4% off of this $70,000. So it's not 4% of this; it's 4% off of the total loan amount. Does that make sense? Okay. So you know 4% is $2,800. And remember from the last video we talked about never a closing cost less than 2%. So that'd be 2% of the $70,000. So there's another $1,400. And then you've got insurance and some other fees. So a deal like this, you're at $3,700, $4,000 to $5,000, about $5,000 out of pocket, plus the $10,000 down payment because you're at 65 and he's only funding 55. So a deal like this, you're going to bring right at about $15,000 to closing, just depending on your lender, his points and fees, and the term sheet. So that's the way hard money works. Now let's talk about conventional financing. Okay, so when thinking about conventional financing for real estate, it's really important to remember that conventional financing is going to be based off of credit and the property. So a lot of people, they see these 3.5 and 4% interest rates and they think, oh wow, I should buy it, use that. You just have to understand that the property is going to have to be in very good condition, and your credit and income ratios are going to have to be well aligned in order to get that low, cheap financing. That's why hard money is so expensive, because they're loaning off of the value of the property and the equity, not off of you, the borrower. So you can use conventional financing to refi hard money, and it's one of those things I really like to do. So you get an 8% loan off of a $100,000 house, you're looking at $80,000. And then most lenders require about 20% down. So in this case, it would be about $16,000. Well, you remember you've already put $15,000 down on this house. So the nice thing about that is now you're looking at a loan of about $66,000. I'm sorry, $64,000. And your loan with the hard money lender is $70,000. So depending on your lender, you're looking at a position where you may even be able to pull some of this $6,000 difference back out of a property and be locked in at about a 4% rate. So now, of course, you've got refinance fees and closing costs, and what most of my clients do is they end up rolling basically all of that into this $64,000 loan, so they don't actually have to bring more money to closing. It's just one of those deals where it's a trade-off. They're okay leaving $15,000, $17,000 in the property, because here's the way this works. At these numbers, this $64,000 loan, your mortgage payment's going to be about $400 a month. And then you'll have roughly $50 a month in insurance. And remember, on this house, we're about $200 a month in taxes, about $250. So we'll just call this $300 in taxes and insurance. And so you're still getting that $1,000 a month that we were looking at. So you've got a $300 a month cash flow. So it's that trade-off. You're putting the $16,000 into it. You're making $3,600 a year. So now that's before maintenance and vacancy, which we've already talked about some of those ratios. But that's where you hear these people talking about they're getting 20% or so. That's how they're doing that math. They put $16,000 in. They're making $3,600 a year in cash flow. So that's conventional financing. I want to flip switches and go into private money and cash for a second. Okay, so earlier in the first video, we talked about cash and using cash, and we went over even some examples of what your return would be on this house. Cash is good to use, in my opinion, for real estate if it's going to be for a short time. What I like to do is, if I was using cash, in that last example, instead of using the hard money loan, you may use the cash and then do a refinance and pull the cash out. The old saying, cash is king. Specifically in real estate investing, that's true. So don't forget, while we're going through all this, if you have any questions, just type them down below. So we're talking about private money. Private money is one of those things in real estate investing that really works well for everyone. And here's why. So $70,000 and $70,000. Let's talk about how my investors make the most money using this type of strategy. So what you could do is, if you were doing this $70,000, or wait, we were talking about $80,000. No, I'm sorry, $80,000. You can go through all the headache and everything that we've talked about to hopefully make your 8%. Now, and that's if you're paying, if you're in this for all cash like we talked about. Well, most of the time, the people that have 80,000 cash lying around are looking for good investments, and that's why they come towards real estate. So what I do is I actually offer potential investors a way that they don't have to manage the asset, where they don't have to manage the construction, they don't have to manage the tenants and the vacancies and put back for escrow and get better insurance rates, etc. So, and if you learn to use this strategy, what will happen is it's like the purse strings just get opened up. So what I offer, say Brian, the investor off the street, is a 10, a 12.5, and a 15-year loan. So what happens is Brian may have an IRA that he got laid off and the money's sitting in the IRA. I tell Brian, look, loan it to me for 10 years. I'm going to pay you 7% interest. For 12.5 years, I'll pay you 7.5% interest. But if you want to give me the money for 15 years, I'll pay you 8% interest. So the nice thing about all this is Brian gets paid whether the tenant pays me or not, because Brian is the bank in this case. So here, if the tenant stops paying, Brian stops making the money. If the tenant vandalizes the house, Brian stops making his return. Whereas over here, Brian's telling me, okay, yeah, I'll take 7%, Tim, because I don't want to do the work. So I'll take it, you have it. And so what happens is Brian then goes into first lien position, and every month he gets a check for principal and interest on this 7%. And once you learn the details of really how to put this together, because it's not a security, it's done on each individual house, you can meet people at the golf course, you can meet them at church, and you'll find that some people that have money sitting around in a CD, I have to laugh because what is that? It's less than 1% that they make. Or they may have it in an IRA or 401k from where they got laid off. But let's face it, a large percentage of Americans have self-directed assets now, specifically with all the layoffs in the last 5 years. This is a very viable option. It's one of those things you can put together fairly easy to where you could borrow this $80,000 and not really have to go through a bunch of hoops. You just want to put the investor into first lien position. He's named on, Brian would be named on my insurance policy as a lost payee. So if the house were to burn down, Brian would get paid off. So that's just a quick look at private money. So that really concludes the financing portion. So the important thing to know about financing is terms. What is your rate? Your rate is your interest rate. What is your term? That's how long you get to borrow the money. You have to focus, a lot of bank financing is really difficult because it has a 1 to 3 year renewal period where the bank can tell you, don't worry, Tim, 3 years from now, everything will be fine and we'll renew. And what happens is you go through a downturn like in 2007 where you may have never been late, maybe 100% occupied, but the bank changes, the economy changes, and so then you're up for renewal and someone pulls the rug out from underneath your investment. So I just always caution people that if you're going to have money owed to banks on renewals, make sure you have money to pay off those loans. Because what you don't want to do is work for 3 or 4 years and then have your investment taken away from you because of a change in policy at a bank. So hard money is great. I use hard money still to this day. Hard money is quick. It's expensive, but it's quick and reliable and easy. So you've got to have yourself a couple good hard money lenders. And actually in an event in a week or two that we're having, we're going to have a local hard money lender there for the Dallas-Fort Worth area. So again, just to recap, cash is good, but try to keep your cash in your bank account, not in your property. Hard money is expensive but quick. Conventional financing is the cheapest, but comes with more conditions, and private money is definitely the way to go. So in a couple days, I'm going to send you a video, and it's going to be about property and project management. So with property and project management, we're really going to get into how to manage a renovation project and how to manage a property, how to renovate a property to where you are going to realize the most gain on the back end. So again, always write your questions below. Watch both of these videos, and in a couple days, I'll send you the link for the third video. Thanks.